Welcome to this overview on options. I'm going to look at options from the fundamental to intermediate level, and what I want to do is to start off explaining my background, explain what we're going to cover, and then we'll take it step by step from there. And there'll be a soft copy of the material that's going to be made available to you. Now, I've been in the markets for over 35 years. I spent the first 20 years in investment banking, either doing corporate finance or derivatives. I actually moved into a derivatives group at one of the American banks in 1991 and covered basically Scandinavia for many, many years across all the asset classes. I ended up at ABN AMRO, the Dutch bank, and used to run the derivatives sales and marketing group there for Europe, Middle East and Africa. I set up my own training company in 2002 and have trained all around the world. I moved to Singapore in 2007 and then to Dubai in 2013. So I do have experience of the Asian and the Middle Eastern markets as well. And I've also done extensive work in Africa. I'm an accredited trainer for the ACI, Financial Markets Association, which basically, with the dealing certificate, shows you have a certain level of competence to work in a dealing room. And I wrote a book for Euromoney on swaps in 2005. The point I like to make about my courses is I want them to be as practical as possible, not just a mathematical exercise. Now, what we're going to cover over the next hour and a half or so is what's an option, who uses them, how are they used, what's the terminology, what's an intuitive way to look at the pricing of them. What we're also going to do is we'll look at things like payoff diagrams. Now, it's really, really important if you use an option, or if you're a banker, if you're going to sell options, make sure everybody understands exactly what's being discussed here. There should be no surprises, no potential conflicts for mis-selling. So always have a payoff diagram, or if people don't understand that, use a spreadsheet. You must always understand the consequences of what you're doing with options, whether you're buying them or selling them. Now, along the way, there'll be various questions. Some of them are actually taken from ACI tests, but they should be fairly intuitive. If you want to see a soft copy of this, go to www.swapskills.com, and I also have some free A5 booklets on Options 101, Options 102, FX 101, swaps, debt instruments, a variety of very interesting topics. If you're doing the CFA, and you have to use a BA2 plus calculator or an HP12C, I've also got a little booklet there which will take you through time value of money and a more practical approach to using the calculator. Not the most interesting subject, but it's got to be done. Now, in terms of what an option is, it's the right but not the obligation to buy or sell a commodity at a fixed price at a certain point in time. Now, when I say a commodity, that could literally be a commodity like coffee, cocoa, sugar, or it could refer to an interest rate, an equity, an FX rate, basically whatever you like. It's just a flexible instrument. With a forward or a futures contract, you've got to do it. With an option, you've got flexibility. So thinking about what I just said, take a look at the four options here, the four alternatives, I should say, which is reflective of what I just told you. Now, this is actually taken from an ACI exam. So most of you should be coming up with this. Again, it is the right but not the obligation, remember that bit, to buy or sell a commodity at a fixed price. When we look at option terminology, many of you will be familiar with calls and puts. A call gives you the right to buy, to call it in at a fixed price at a fixed date. A put gives you the right to put or sell a commodity at a fixed price. So call is the right to buy, put's the right to sell. Now, the reason I intuitively do this with my hands is in the old days in the futures pits, it was so loud people had to shout at each other, they had to use hand signals. So if you're going to buy a contract, it's always hand towards you. If you're going to sell, it's hands away from you. So a call option is the right to buy. If you've bought the option, you are long the option. And for that option that you have bought, you will pay a premium. Now, the premium is normally paid on the day you buy the option, and it actually goes through the account, usually 2 business days from that date. If I like you, I might defer the premium and let you pay at a future point in time. Obviously, I have a bit of a counterparty risk on you then. If you sell an option, I will pay you. Now, if you sell an option, people also use the terminology, you're writing an option. So selling an option or writing the option means the same thing. So I will pay you the premium. But don't just remember, I've paid you for a good reason, because there's a possibility you might have to pay me back at a later date. So be aware of the consequence of selling an option. Now, when we say dollar call, yen put, remember, if I'm buying something off you, I'm probably giving you something in return. So if I had a dollar call, the right to call in or buy dollars off you, I must give you something in return. A yen put, I'm selling you yen. So buying dollars, selling yen. Dollar call, yen put. So remember, dollar call is the same as a yen put in this context. So two sides of the same coin. So do take a look at this. 50-50 chance, things are looking good. You can call a friend if you like. What option gives the right but not the obligation to sell? Is it a call or is it a put? And hopefully you're intuitively thinking it is a put. So it is a put option, the right to put the good. Now, this is also related to what we just looked at, the seller of a call option. Which of these four alternatives do you think relate to the seller of a call option? And let's take a look, and it is for a substantial risk of loss, limited opportunity for gain. So if you sell an option, the most money you're earning is the premium I've paid you for that option. But if the market goes against you, you sold me the right to buy something off you here. If the market goes up and up and up and up and up, you could have a potentially unlimited loss. So unlimited potential loss for a pretty limited gain. Now, in terms of an overall view of the terminology, we said if you're long, you bought an option. If you're short, you've sold it. There are different types of options. European, American, Bermudan, path-dependent, digital, Asian, 4, 5, 6 different types. Now the reality is you will ever only be exposed to European style options. What I will do is explain exactly what that is and what some of the others are as well. I'll give you an option on pretty much anything you like. Interest rates, commodities, credit derivatives, equities, weather derivatives, insurance derivatives. All it's about are two key things. What's the probability it's going to happen? And if it does, how much money do I think I'll have to pay you out? Now let's look at that in context of credit derivatives, for example. What's the probability you're going to default? Well, do you have a credit rating? Maybe Moody's or Standard & Poor's, two of the key rating agencies, have historical data going back to the 1920s, which will show me in America, for example, what's the probability of a single A-rated automotive company going bust over the next 5 years. It'll actually give you that percentage probability. If a company goes bust, do you lose everything? Well, no, because the company will hopefully have assets you can sell off. Tables, chairs, computers, the property itself. So the market assumes that for investment grade debt, for senior debt, you can recover 40 to 45% of your money. You're going to lose the other 55%. Now, obviously, the amount of money that you recover will show you your expected loss, but that's going to differ from one industry to another. So if I'm dealing with an industry with a lot of tangible assets, like an engineering company, great, there are things I can sell. But if I'm dealing with a consulting company, it's intellectual capital. There aren't very many tangible assets. So what I'm looking at with a credit derivative of what's my expected loss and what's the probability I'm going to experience that loss. That's all it is. That's basically insurance, that's basically options. Now I said that the most common type of option you're going to come across is a European style option. With a European style option, typically you get one phone call. So you pay me a premium today and we agree that at a point in time, 3 months, 6 months, a year, whatever, you will phone me and you will exercise or you will not exercise your right to buy or sell a commodity on that one day. So one phone call, one day in the future, relatively straightforward to price. Now when we look at an American style option, what this allows you to do is call me up any time between now and the expiry date of the option. Now that flexibility to call up any time will cost you an arm, a leg and a kidney. Now most times option buyers of American options don't exercise it at the most efficient time, but that's beside the point. That flexibility makes it an expensive option much more than a European style option. A Bermudan option is named after the island of Bermuda, would you believe it? You know, you hear about the Bermuda Triangle. Bermuda lies in the North Atlantic physically between America and Europe. So it's not as flexible as the American, but it's more flexible than the European. In other words, you have more than one occasion when you can exercise the option, but you can't do it any time you like, just on certain dates. So let me give you an example. This shows a type of bond, a callable bond, multi-callable, because it's callable on many occasions, and this is what we would call a 10-year non-call 5. What on earth does that mean in English? Basically, it's a bond with a maturity of 10 years. It cannot be called or repaid early by the issuer for the first 5 years. So if you're the investor, obviously as long as the company doesn't default, you're guaranteed you've got an investment for the first 5 years. But then on the 5th coupon date, 6th, 7th, 8th, 9th, and obviously 10th, the issuer has the right to repay you your money back. Now, why would they want to repay you your money back? Is it if rates have gone up or rates have gone down? Why might you get a phone call, for example, on the 7th coupon date with 3 years left to go, where the issuer wants to pay you back? Have rates got higher or rates got lower? Well, they would do it if rates have got lower, because they'd be saying, why am I paying you interest here if rates have now gone down here? Doesn't make sense. So you know what? Have your money back. Well, that's all very well for them, but your problem is you've now got your money back, which you have to invest at the lower rates. So you're thinking, oh, this is just great. I should have just bought a nice, normal bullet 10-year bond, being guaranteed a return for the whole 10 years. Now you've got a reinvestment risk. So in return for taking this risk, investors will receive a higher coupon. So instead of receiving, let's say, 3%, if you could, you'd receive, say, 3.3%. So whatever happens, you're guaranteed the extra 0.3% or 30 basis points for the first 5 years. And you just better hope that's enough compensation for the potential reinvestment risk that you faced. So that's the Bermudan, a multi-callable. Let's take another example, Asian style options. Now, if you hear the word Asianing in options, it's usually found in commodity options or foreign exchange, FX options. Now, if you remember, with a European style option, you had one phone call to make, one day on which you could exercise the option. Well, what if that was the day when the market either spiked up or dropped like a rock? If you're the seller of that option, you'd think, oh, this is just great. I've got a risk that on that one day, everything bad happens. Now, at the end of March 2020, on one day, the Dow Jones went up by about 10 to 11%. If you had sold somebody a call option, you'd be paying out a massive payout, because on that one day, the market decides to shoot right up. Well, the way it works with an Asian option is, instead of observing the market on that one day, we will observe that market on several dates prior to maturity and take the average rate. So if the market does spike up on one particular day, it'll get averaged out among the other observations. So what that means is there's a less volatile payoff, which means if I've sold you the option, I won't have to pay you so much money. So the premium will be lower. Well, people will use this where they will look at, for example, a strike compared to the average rate over the past, say, 3 months. And they might do that because maybe their income statement is revalued against the average FX rate. Or if you look at commodity swaps, you look at the average of the commodity price. So different reasons, motivations why somebody might want to do that. When I used to sell equity-linked products up in Sweden, we would do averaging for the first 6 months maybe going into the trade, and for the last 6 months coming out of a trade, because it reduced the cost of the options, which gave us more money to pay as a coupon to investors. Now take a look at this. What I want you to do is look at these 4 lists of options and put them in order from the most expensive option to the least expensive option. And you should be coming up with number 4. So American is the most expensive, gives you a lot of flexibility. Then Bermudan gives you flexibility more than the European. So the European is 3rd, and finally Asian. Now something else which you may hear about is digital options or binary options. They're the same product. Now, when I was at school in the 1800s, we had to do binary maths, completely useless, but people thought there was a purpose for it in those days. And basically it's about ones and zeros. Now they call it a binary option. It's also called a digital option because digitus is a Latin word for finger, so it looks like the one you see in binary, 1 or a 0. The way that works is you have a fixed payoff. So let's just say we're looking at the euro-dollar FX rate. So €1 is worth $1.10 exactly. I'll do a deal with you that says that in a week's time we will observe the euro-dollar FX rate. If it's 110 or higher, so 110, 111, 112, I'll pay you $5 million. If it's below that, you get nothing. So whether it's 1.1001 or 1.5001, it doesn't matter. As long as it's higher than 110, I'll pay you a fixed rate, 1 unit, that we pre-agree. If it's below that, you get nothing. So that's a digital option, and we use these a lot in principal protected products called range accruals or range deposits, where the principal is at risk, it's just the coupon that is at risk. So take a look, another few questions for you to think of, and what I've asked here is what is the fundamental difference between an option and a forward contract? Now, financial futures, forward contracts basically operate in similar ways. Take a look at this. So when you've gone through all the alternatives, you should be seeing that an option requires premium. No margin payments. You don't have to do it exchange traded. You could do it between you and me, what they call an OTC or over-the-counter option, and it gives you more flexibility than a forward contract because you're not locked in. You can walk away if you see a better deal. Other key phrases you'll hear will be exercise date. So we need to know the exercise date and also the strike price, the level at which you have the right to buy or sell. Now, a strike price and an exercise price mean the same thing. They're just denominating what level you can buy or sell at. So who uses these options? All sorts of people use them. Now, when it comes to commodity derivatives, the largest users of commodity derivatives are actually speculators, speculating on the price of gold, silver, palladium, platinum, lead, copper, zinc, you name it. They're the largest users of commodity derivatives. When it comes to equity derivatives, it's usually portfolio managers buying put options on their portfolios. So if the market drops down, not their problem. They have the right to put an equity or an index at a given price. Now, when it comes to corporates, you see this a lot in trade finance when we have cross-border cash flows and exposure to currencies, because the last thing you want is to have the best product in the world bought by loads of customers, but because you're sourcing your inputs, your raw materials from another country, you could wipe out your margins if the FX rate moves against you. So imagine this, imagine you're European and you're buying goods from Japan to use in your factories in Europe. So you're buying goods from Japan. What's the worst thing that can happen? The worst thing that can happen is yen appreciation. Because what happens if the yen goes up, it means you're selling more euros to buy the yen you need to pay for the goods. If you're worried about something going up in value, what do? Do you buy a call or buy a put? Buy a call. So have the right to buy yen here. So if the price of the yen goes up, that's not your problem. You've already bought the yen at a cheaper rate. So I want to make sure that if the yen appreciates against the euro, I'm protected. Now, an option will give me flexibility because when I come to buy the yen, I can compare the option strike to where yen are available in the market. Now, what I've shown here is an example where you have bought a call on the yen, which means you have bought a put on the euro at a strike of 125. So what that means is if the market rate on the day I need it is less than 125, doesn't matter. I have an option to get at least 125 yen for my euro. So think about this. What would you do if the euro-yen exchange rate was 120 yen to the euro on the day that I actually need them? What would you do? Would you exercise your call option? Absolutely you would, because why would you exercise them if the yen goes down to 120, that's not very good. I'll exercise my option to get in 125 yen from the bank. So you'd exercise the option. What if the yen had gone to 130? Would I exercise the option? No. Why buy yen from the bank when I'm only getting 125 yen when I can get 130 in the market? So all that happens is the option goes unexercised. All you've lost is your premium. So this is where you've got flexibility. Well, what about the other side of the coin? What if you were in Japan buying raw materials from Europe? So what you're worried about is maybe euro appreciation. So what you want to make sure of is that you're selling as few yen as possible to the bank to buy the euros that you need to buy parts from Europe. So what you do is you're going to buy put on the yen at 125. So what that means is it's a maximum amount of yen you have to sell to the bank to get a euro back. Now, if euro yen goes to 130, what are you going to do? Why pay 130 yen to the market to get a euro when you have an option to get them for 125 from the bank? Forget it, I'll exercise my option. Similarly, if the euro yen rate goes to 120, well, why pay 125 yen to the bank when I can get them in the market for 120? So your option goes unexercised. So sometimes just stand back and just think in terms of cash, what makes sense. So take a look at this. I've given you 4 definitions here. One about the advantages of buying an option. Which do you think is the most appropriate to what we've just discussed? Okay, and you can see here the most appropriate is it limits downside risk. Does it limit upside potential? No, not if you've bought an option. Do you know with certainty the rate you will use in the future? No, but you know the worst. If you knew with certainty, then that would be off a forward contract. When it says no credit risk on the provider of the hedge, you absolutely do have a credit risk on the provider of the hedge. So if you buy car insurance or medical insurance, you pay a premium, but you better be sure they're going to be around to pay you out in case they go bust. So here it's limiting downside risk. The next stage I want to look at is, and this is an awful word, moneyness. Somebody obviously ran out of vocabulary here, and it looks at the different strike levels you can have on an option. Now, let's just take a commodity, any commodity. Let's say it's worth $100 today. That is the spot value, the price you would pay on the spot here and now. So if you have an option to buy or sell the commodity at that price, that's at the money spot. Mainly time value, there's no intrinsic value at all. So the longer the option, the more you'll pay, but there's not really a fat lot to it. Now, this is more important, at the money forward. Forward pricing is fundamental to the markets, whether it's for using forward contracts or for option pricing. Let's just say that something is worth 100 today and you want to buy it off me in 3 months' time. Well, in 3 months' time, I've had to hold it for 3 months on my balance sheet, so I've had funding costs. I've had to store it somewhere, so I've got storage costs, maybe insurance costs as well. Basically, the cost of carrying this asset on my balance sheet. If I'm lucky, maybe whatever it is will give me some return during that time. Maybe I'm holding a bond or an equity, maybe it'll give me some dividend or interest income. But if it's a commodity, it probably won't. So the forward price should be higher than the spot price because I've had the funding cost, the insurance cost, the storage cost. But the forward price shows me really what you should pay for it to cover my costs in 3 months' time. That's at the money forward. So if you have the right to buy it off me or sell it to me at that price, what we're saying is that's pretty much what it's worth anyhow. So it's 50 delta. Oh, hold on, what this was delta. Now be careful, delta means different things to different people. Delta, in one definition, means the amount by which the option premium, the cost of the option, will move according to how much the underlying asset moves up and down in price, the asset on which you have the right to buy or sell. In this case, think about it as the probability it's going to happen. Delta in the markets is a number either between 0 and 1 or 0 and 100, depends who you speak to. If something is 50 delta or 0.5 delta, there's a 50-50 chance it's going to happen. You've got the right to buy or sell something at what I think should be done. If the probability of it happening, being exercised, goes up, it's more likely to happen, that number will go from 50 to 60 to 70 to 80, it'll be 80 delta or 0.8 delta, and if it's a call option, it'll be a positive number. If it is not likely to happen, then the lower the probability means the delta will go from 50 to 40 to 30. So 30 delta, it's less likely to happen. But if you do hear this word delta, if it's a call option, it's a positive number. If it's a put option, it's a negative number. So if I said it's got a delta of plus 0.5, it means you've got a call option at the money forward, 50-50 chance it'll happen. If you had a put option at 50 delta, put option would be minus 0.5. Now, if you remember, so what I've done here is on the slide just to make it clearer. Call option at the money forward, plus 0.5, put option, minus 0.5. The reason I'm going on about this is this does come up in things like the ACI exam. Now, what if something is in the money? If it's in the money, it's pretty likely to be exercised. So if I looked at my laptop, which is worth, say, a couple of $1,000 and gave you the right to buy it at $50, yeah, you'd be mad not to buy it. Almost certainly you're going to exercise the option. So that would be in the money. That option would clearly be very expensive. It has a lot of what we call intrinsic value. So to have a higher delta, the delta is getting closer to 1 or closer to 100. If it is out of the money, it's less likely to be exercised. So if I said you have the right to buy my $2,000 laptop off me for $4,000, yeah, it could happen. I guess there could be an unusual spike up in laptop prices. Probably not going to happen to that extent. So less likely to happen, lower delta, it's out of the money. Now, sometimes what some companies will do is they will buy low delta or out of the money options just in case the market spikes up or spikes down. Now, if you'd done that at the beginning of 2020 when the market dropped like a rock, you'd have probably done quite well off it because you haven't spent much premium because it's low delta and you've had a big payoff. This is one of the reasons why traders actually don't like to sell low delta options, because they're not earning a fat lot of money. And if the market does shift a lot, especially if it shifts quickly, they just simply haven't got a chance to hedge. And so they end up paying out a lot more than they ever earned. So as a sales guy, you might say, hey, it's a good idea to buy a low delta option. You never know. But the traders really won't thank you for it. So take a look at this. Four questions for you. What I've asked is, if an option is described as out of the money, which of these deltas would apply to that statement? And hopefully you're coming up tends towards 0. So the lower the delta, the more out of the money the option is going. So let's actually have a look at intuitive options pricing. Now, I'm not going to go into the nitty-gritty of the maths of Black-Scholes, Cox-Ross-Rubinstein, and some of the other models. I just want to give you a heads up for this particular course on the key ingredients of option pricing. You'll see it's actually pretty intuitive. And to be perfectly honest, you've got the models on Bloomberg and other tools, but you really need to know what's in the black box. So what have we discussed so far? We've said I need to know the probability something's going to happen. If it does happen, how much am I going to have to pay out? How long is the option for? And what type of option is it? Is it American, European, Bermudan, or path dependent? What I'm really trying to think of is this. What is my expected payoff at a future point in time? And what is the present value of that payoff? So take a look at this. Imagine we're sitting together today and you have an option to buy a widget off me in, say, 6 months' time at $106. Well, the market says $106, that's the strike. Great deal, because the market thinks you should really be paying $110. That's the forward price. So if you're buying it off me for 106, not 110, that means there's going to be a $4 payoff. Now this $4 payoff, this is intrinsic value, built-in value. So if everything turns out as it should do, you've definitely got a $4 payoff. Now this isn't going to happen for another 6 months. So I'm going to pay you $4 in 6 months' time. What we'll do is we'll discount it back to today back to a present value. Now, just to make the numbers easier and more demonstrative, even though interest rates are stupidly low, I just discounted at a rate of 5%. What that means is that $4 in 6 months' time is worth, or say a year's time, is worth $3.80 today. So that is the present value of the expected payoff. Now, what's the probability that's going to happen? Well, let's say there's a 50% probability. So 50% probability, I'll have to pay you out $3.80, which means I've got a payoff here of $1.90. Now, on top of that, I've added on a figure of 40 cents, so just plucked a number out of the air. This is what we call time value or extrinsic value. What this is reflecting is a couple of things. First of all, obviously, the longer the option, the more I'll charge you. But also, this is where I'm going to factor in how volatile the market is. So common sense says that the more volatile the market is, the more the likelihood you are to call me up and exercise it. So guess what? I'm going to charge you more. So back of the envelope, I'm going to charge you $2.30 for this. This is just, again, the conceptual approach. Now, if you actually look at the Black-Scholes formula, what they do is they look at the difference between the forward price and the strike price and discount it back to a PV. So when you look at a payoff of, say, a call option, remember a call option is the right to buy, you can see that as the price gets higher, the call option will go up in value. So you can see the blue line going up in value. What the orange bit around is reflecting is the extra I've added on for time value. So you might actually get an option which hasn't yet hit the strike, where the market hasn't hit the strike rate, but the option's still worth something because you've got the ability that maybe the market will come back in your favor. That's where you factor in the volatility. Now, this is where it starts to get a little bit tricky in terms of thought process, payoff diagrams. Now, some people refer to these as hockey sticks because they look like the hockey sticks that you find on an ice rink, so it has that particular pattern. You need to understand how these work if you're going to use options, especially if you happen to be ending up in banking. You need to understand to a client how they work. If you don't like these, then do a spreadsheet, do whatever it takes. People think in different ways. So let me just deconstruct a payoff diagram so you can see how it's put together. Once you've got the hang of it, it's actually really straightforward. So first of all, this bit over here on the left-hand side, this is the profit or loss. So when I say loss, it doesn't necessarily mean loss. It could be just actually premium that you've paid. Now what I'm going to do is I'm just going to use the spotlighter here. So anything here, this is money you've made off the option, and anything down here is money that you have paid out under the option. It could be a premium or it could be an actual payoff if you sold the option. Going from left to right, this is the price movement of the underlying. So let's just say you're looking at an option on oil. This is oil prices getting higher. These are oil prices getting lower. Now we have to set a strike price. So strike price at which you have the right to buy or sell, let's say oil, would be very, very clear. What else have we got? We've got the break-even point. Now this is a diagram for a put option on oil. So imagine if you're an oil producer, you're worried about oil prices going down, which has been very topical. And what you've said is if oil prices go up like this, that's fine. But if oil prices go down, not so good. So you bought a put option, and the put option, if you look here, once it's gone past the strike A, as oil prices get lower, that option is going to go up in value. Now pretty soon it's gone up enough so that you can actually make enough profit on the option to cover the cost, the premium. Beyond that, you see where my spotlight is now, it's pure profit for you. So you need to understand what's the premium and where is the break even. At what point does an FX rate have to be hit, or a commodity price or an equity price to recover your money. This is in the loss part of it. It's not really loss, it's just to represent the cost. There's no such thing as a free option. You've got to pay for it. Now look at this. If the price of oil had gone up, moving to the right, would you exercise the option? Why sell it at a lower level when you can sell it at a higher level in the market? All you've lost is your option cost. But if the price of oil goes down, your option's gone up. We said this is a break even. So if you put it all together, what it means is if you put your finger here on the strike price, you've lost a bit of money on the option. As the price of oil moves up, all you've done is lost money on the option premium. As the price of oil moves down, you break even, and beyond that is pure profit on the option. Now what I'm going to do is I'm going to show you 3 payoff diagrams. We're going to have this payoff diagram here of the plain vanilla put option. Now by the way, vanilla, let's just explain that. I don't know about you, I like ice cream. I find chocolate interesting, strawberry ice cream interesting, but vanilla, it's just so boring. Vanilla, there's just no flavour to it. So when we come to something really boring in the markets that's not particularly interesting, we call it vanilla. So you have vanilla swaps, you have vanilla options. So there's no knock-in, knock-out, it's not sexy, exotic, whatever. It's just a normal, plain vanilla option. So this is why you hear about vanilla structures in the markets. Now what I'm going to do is show you 3 diagrams. The first will be this, the normal payoff profile for a put option. The middle picture will be what we call a long underlying position. That's just a clever way of saying you own something. So if the price goes up, you make money. If it goes down, you lose money. A long underlying position. If you're long, you own it. The third diagram will be a combination of the two. So where you're trying to protect yourself against the value of your position going down. So let's just take a look. So if you look at the one in the middle, first of all, this is your long underlying position. As the price goes up, you're making money. As the price goes down, you're losing money. Now what I'm going to do is combine this with the put option here. So what happens here is that as your underlying asset goes down in value, as prices fall, you're losing money here, but you're making money on the put option, aren't you? So what you gain on here offsets what you lose here, and basically they offset each other. Your maximum loss is your premium. So let's just say you buy something for $50. It costs you $5 to buy a put option. If the price goes down to 45, 40, 35, you're protected. The maximum you'll lose is the $5 premium, so your net loss will be $45. But look at this. If the price, let's just go back a second. If the price goes up, pretty soon you've made enough money here by the price going up to cover the premium for your option. So this is your break-even point. After that, it's pure profit on your position. So this is how hedging works. When we say hedging, we mean protecting the value of a position. Other structures. Now there are different ways we can reduce the premium of an option, or we can put on speculative trades, whether you think a market's going to do lots or do nothing at all. So let's just show you how some of these other payoff diagrams work and other structures work. Now this first one on the top left, this is a long spread position. I don't know who thinks up these phrases. This is a call spread. Now if you remember, a call is the right to buy. So have a look at this. You pay your premium, and if the underlying goes up because you have a call on it, you'll make money. Now what's this bit here? It seems like your ability to make money is being capped out. Well, what's happened is you've combined buying a call with selling a call. Now if you buy a call, I'm going to charge you money, this premium here. But if you sell a call, I'll pay you some money back. Now what it means is your net premium between the two is going to be cheaper. Going to be less. Why would you do that? Well, think about medical insurance. Now, when I lived in Dubai, we have to have medical insurance. It's a legal requirement. So someone like Aetna or one of the big insurance providers will say, right, if you want insurance, I'll charge you $2,000 a month. You go, $2,000? You've got to be kidding. Well, your hospitals are expensive. Do you think you'll fall ill? Well, no, I feel pretty good. Maybe something, break an arm, break a leg, but nothing serious. Okay, I'll tell you what. I'll cap your medical insurance, and in return for capping your medical insurance at say $500,000, I will reduce your premium. Okay, fair enough, you're on. So by capping their payoff, the insurance company will lower the premium. That's what you're doing here. By capping, limiting the payoff, the option cost will be less. So that is a long call spread. You've bought a call, you sold a call at a higher strike, so you have protection up to a certain point. Well, let's just imagine you're an airline buying a call option on oil because you're worried about fuel prices going up for the airline. You might be thinking fuel prices will go up, but they won't go beyond a certain level, so you're willing to limit your protection. What's the worst thing that can happen? Well, the worst thing that can happen is Russia, Venezuela, Saudi Arabia close down production, oil prices shoot up, and suddenly the protection you thought you had isn't enough. So you've got to really think through why you've got this strategy on, what's the possible downside. Similarly, if you sell a call, you can earn money, that's great. But remember, if you sell a call, if the market goes to the stars, you're going to lose everything. So what you might want to do is limit your potential loss by selling a call at one strike, buying a call at a higher strike. Now, you do sort of protect yourself, but by buying a call, you are going to reduce your net premium. So this concept applies to puts as well. You might think something's going to go down. So look at this bottom left corner. You buy a put, there's your premium. As the market goes down, your put makes money, but you limit it because you don't want to spend so much premium around here at the beginning. So let's just have a look at this. What would you say this structure represents? Is it a long call spread, a short call spread, a long put spread, or a short put spread? Think about this. This is the structure we just looked at just a second ago. So this is a long put spread where you buy at strike A. So there's where you bought a put. So you see there's a premium that you spent. Oh, hold on. There's a premium you spent, and if the market's correct, as the prices go down here, your put option will go up in value. So you buy a put, but then what do? You sell a put at strike B. So by selling a put, if the market goes down, you pay out. So what you're earning under the put you bought is now offset by what you're paying out under the put you sold. So this is your net position. So this is why there's a premium paid, you make money, and then you're neutral again. So just think about how the options overlay each other, what the premiums are. It takes a little bit of getting used to, but once it clicks, it's actually not that difficult. You can deconstruct various structures. Other structures you can do. This is, and I apologize, I don't know who thinks up these names. We have bearish seagulls and bullish seagulls. Some dealers have way too much time on their hands. Now, this is also called a three-way collar, and these are quite common when you look at commodity hedging. So what I want to do is look at this bullish seagull. Let's just break it down a bit. Well, just look at the first structure here. Look at where my cursor is going. So where it says you sell a put at strike A. So if you sell a put, I'll pay you premium. But if you sold a put and the market gets lower, the put you sold is going to cost you money. You sold somebody the right to sell here. So if the market goes down, you're losing money. But I'll pay you for that. I'll pay you for the put you sold. Now let's just look at these two lines here. This is a classic payoff structure for a call option. So you buy an option, a call option, but if the underlying prices go up, your option goes up in value. But of course you bought an option, that's going to cost you money, isn't it? So how are you going to subsidize that? Well, some of the subsidy comes from having sold the put option on the first leg. So you sold a put option, you bought a call, and then on this last leg, you sell a call. You sell a call at strike C. So what it means is, although you're earning under the call option you bought, you're having to pay that out under the call option you sold. So that's why your upside is limited. Why would you do this? You would do this because you think, for example, a commodity is going to go up. So again, let's use the example of airlines. You think oil prices are going to go up, but not that high. So if you think oil will go up but not that high, you buy a call option on oil, but you sell a call option on a higher strike to earn a bit of money. If you happen to think oil price is not going to go down either, sell a put and you're getting paid for something you don't think is going to happen. Or even if oil prices do go down and you're exercised under the put you sold, That's a shame, but the rest of your oil production that you're having to buy for your airlines is getting cheaper. So you can, think about it that way. Now let's have a look at a couple of other structures. A straddle. I'm British, and back a few years ago, as you probably know very, very well, we had a referendum on should we stay in Europe. Now, if you look at the sterling dollar exchange rate or cable FX rate, normally it hovers around 150 to 155. So £1 gets you $1.50, £1 gets you $1.55. During the referendum, people knew that if the UK decided to leave, or Great Britain decided to leave Europe, sterling would drop like a rock. Similarly, if we voted to stay in, it would probably appreciate, out of relief. It was going to do something one way or the other. You're just not sure which way it's going to go. So to get the best of both worlds, you do two things. You buy a call. So you buy a call option, so your benefit if the market goes up, and you buy a put, so your benefit if the market goes down. So either way, you're going to make money. But the trouble with this is it's going to be expensive. So look at what I'm doing here on the screen with the cursor. So there's your payoff if the call option is exercised, great. There's the payoff if the put option is exercised, yeah, brilliant. But you just spent money on two options. And if the world doesn't know really what's going to happen, it's probably going to be quite a volatile time. So it's going to cost you, again, an arm, a leg and a kidney. So these break-evens here are going to be quite far apart. So you better be pretty sure the market is going to move enough to recover the premium on the options. But either way, you've got the best of both worlds. Now, what if you got the other view? Have a look on the right-hand side. We've got a short straddle. This is where you sell a call and you sell a put. So you sold a call, you sold a put. I'll pay you for those two options you've sold. You're making a lot of money here. And as long as the market stays within this range, neither the call nor the put are being exercised, are they? So you get to keep the premium from those two options you've sold. Happy days. But if you got it wrong, you won't have enough organs to sell on eBay to make back the money you've just lost. So if the market shoots up to the stars, the call option you sold is going to cost you a lot of money. So you better think, how could you either reduce the risk of losing everything or reduce the premium? Now let's just take a look again at how the straddle is constructed. So there are two options. First of all, this was the payoff on the call option. So you're buying the option, there's your premium cost. There's the payoff on the call. And you're buying a put option. So there's the premium you get paying on the second option, and there's the payoff. So what we do is we tend not to draw in these lines for where the premium is. We just show the payoff on the two options. There's another structure called a strangle. Again, forgive me, I have no idea who makes up these names. So whereas the straddle is quite expensive because the two options are struck at the money forward, with the strangle, the strikes are moved apart. So they're slightly out of the money. Now, if the strike is out of the money, it's less likely to be exercised, so which makes the option lower cost. So what it means though, although the option is lower cost, the market has to move further with those options to realize any money for you. But it's just a more conservative way or a cheaper way to put on a view that the market is going to gap one way or the other. By the way, when I say the word gap, if a market gaps, it means it's moved sharply one way or the other in a very short space of time. And sometimes traders just simply haven't got time to hedge or close out that position if it's gapped up or down. Even if they could, sometimes you usually find in those sort of markets, liquidity dries up. And when they use the word liquidity, all they're saying is there aren't enough other people in the market to get a price from. So you'll find this. It doesn't matter what your business professor tells you in college about how to price up a bond, discounting the cash flows and so on. Sometimes if there's no bid, there's no bid. The traders are all square. They don't want to do anything. Good luck to you. It doesn't matter what the formula says. That's the key thing that kills a trader. Now let's look at a couple of other structures here. This is a butterfly. Again, have you ever seen a butterfly doing that? This is daft name, but it's one of those that you hear. Have a look at the structure on the left. So what is this? This was like the short straddle where you sell a call and you sell a put. Now I did say that if you sell a call, you have a potentially unlimited downside. So what you do is you sell a call here, but you buy a call at strike C. So if the market goes up, although you're paying out on the call you sold, you're earning on the call you bought, so you're limiting your potential losses. Now, by buying that protection, by buying protection on the wings that strikes A and strikes C, you're going to have to pay for that. So it will reduce your overall income, but at least you can sleep at night just in case the market has a crazy day. So what would you take a look at this? What would suit your view if you believe that the market will move one way or the other, you're just not sure which way, and you don't want to pay too much to take this view? What would you do? What sort of structure? Think about what we've just done. Now, there are at least two structures that would fit this. What I would do is I would look at one of these structures here. Let's see which one. Now, you could have said the butterfly. I'm not thinking of a butterfly. Would you use long straddle, short straddle, long strangle, or short strangle? So you believe the market will move one way or the other, you're not sure which, but you don't want to spend too much money. In this case, you're going to do the long strangle. So if you remember, the strangle is buying a call and buying a put slightly out of the money, so the premium won't be too much. So there you go, there's the payoff diagram on the structure. So you can see here, you can see we've got the call and the put. So we're covering a lot of ground. What we've done so far is we've looked at who uses options, we've looked at some of the terminology, and we've looked at the payoff diagrams. What we're going to do now is we're going to look at option pricing. Now, I said earlier, we're not going to go into the deep maths of it. What I want to do at this stage is just to look at the intuitive approach to pricing up options, pricing up that flexibility. One of the most common pricing models you'll have come across is the model produced by Black and Scholes. They won a Nobel Prize for this many years ago. The model they came up with is fairly straightforward nowadays to look at, and it's really more appropriate for European style options. If you want to do American style or something a bit sort of more exotic, Black Scholes is a bit too basic. Now, they had to come up with some sort of parameters for this, and they said, imagine a world where you could always trade, where there's always a market, you can borrow at risk-free rates, no taxes, no dividends. I mean, this is just perfect. How nice would that be? Now, we know the world's not like that, but it's a starting point for option pricing. Now, the key ingredients that go into the option pricer will be what? We said, how long is the option? 3 months, 6 months, 1 year? Obviously, the longer you go out, the more you'll pay. Is it European, American, Bermudan path dependent? What's the interest rate? Now, why do I need interest rates? For two reasons. First of all, it helps me work out forward prices, but also if I'm going to discount the payoff from a future value back to present value, I need to know the rate. What's the volatility? Obviously, the more volatile the market is, the more likely you are to call me up, the more I will charge you. And finally, what's the underlying index? Is it an index like the Standard & Poor's 500? Is it an FX rate, an equity, a commodity price index? What's the story? And finally, what's the strike? What's the level at which you have the right to buy or sell at? Because that will determine the expected payoff. Now, when it comes to things like volatility, you can't just go down the supermarket and buy a load of volatility and see it off very easily. It's not a tangible asset. And you will hear people talk about historical volatility and implied volatility. Now, the way we work out what volatilities the market's using is we have to derive it backwards. So if I know the ingredients in my option, the strike rate, the interest rate, the time, and so on, and I know the premium being charged by the market for the option, then I can imply what volatility level is being used in the market at the moment to make these stars come into line. So this is called implied volatility. I did tell you that if volatility rises, say it goes from 10% volatility to 11%, the more I will charge you. That change in value, going from up 1% in volatility, is what we call vega. You'll hear people talk about the Greeks. What's happened is when it comes to analyzing price movements in options, people use Greek letters or quasi-Greek letters to measure the different inputs. So vega measures the amount by which a premium of an option will move. The according to a change in volatility. Now, this volatility that's being used by the market, it's not the same for every strike, for every maturity. Some maturity is more popular than others, and what you find is there's a so-called volatility smile, where you might feel that volatility is being priced or underpriced for certain parts of the market. Now, a key part of the discussion on volatility is standard deviations. If you look at the distribution of, say, share prices, FX rates, equity rates, you'll find that if we look at a forward forecast of prices, most of the prices will fall within a 2 standard deviation range. Two-thirds of the levels will fall within a 2 standard deviation move. Now, I don't know if you've ever been to Antarctica, but if you go to Antarctica, you'll see emperor penguins. Most of them are around 1.1 to 1.3 meters high. But every now and then you find one that's stupidly tall or a little bit shorter, but 2/3 of them will be between 1.1 and 1.3 meters high. So if it goes out to 2 standard deviations from that, 3 standard deviations, that's pretty rare. It's not often you'll find a really tiny penguin or a really large one. This is where we look at things like tail risk. Tail risk or black swan events are rare events when the market has moved 2 or 3 standard deviations. Most of the time you'll fall within a certain distribution. Now, with the coronavirus and the pandemic that we've had, you see people talk about flattening the curve, and this is where we look at trying to reduce volatility and payoffs, and in this case reduce the number of casualties. So this is an example of a volatility smile, and you could see that if you look along the bottom, you could see at the money strikes. When it says C, it means it's a call option, and P is if it's a put option. And you can see the delta, if it's 45 delta, 40 delta, 30 delta, so going out of the money. And up the side you can see the volatility. So you can see this volatility smile, so it's not a linear concept. I thought it might be quite useful to actually show you how Vega looks when it comes to pricing up an option. And I've taken up an example of a euro option with the euro against the dirham. Now the dirham is the currency used in the United Arab Emirates, with Dubai and Abu Dhabi and so on. Now what I've done is I've priced up a basic vanilla call option. Now this is struck such that €1 gets you about 4 dirhams 28. And if you look at both the left and the right sides, all of the inputs are exactly the same, the maturity and the strike. The only real thing that's different on the inputs is the volatility. So with the option on the left, you'll see that what I've done is put in 7.5% volatility. And then on the right, we have, see that, 8.5% volatility. So just a one vol change. Going down, you'll see Vega. See this Vega here in the middle? It says 2006.6. What that means is if volatility moves up or down by 1%, the option will move in value by just over €2,000. So concentrating on the option on the left, let's go down a bit. The premium for the option on the left is €15,051. That's based on 7.5% volatility. If you look at the premium on the right, I moved volatility up from 7.5% to 8.5%. What's happened to the premium? Of course, it's gone up. To what level? €17,057. If you look at the difference between those two prices, between 17,057 and 15,000, there you go, that was your Vega. So that's how Vega shows you the price difference according to a change in volatility. And what you find is if you work in derivatives on a sales desk, you'll say to the trader how much you're taking out of it. He might say I'm taking out half a vol or 1 vol, and he'll say it's a half vol spread, depends on the option, so you can see the P&L, the profit and loss of that particular trade. So thinking about, again, ACI definitions, take a look at the 4 definitions here for volatility, and what do you think is the most appropriate definition? And we should be coming with B. So it's a variability, but not the direction. Direction doesn't matter. It's how volatile a price is. Now, in this case, I put the underlying currency exchange rate. Could be a commodity price, an interest rate, equity. It doesn't matter. It's just the volatility, the variability. It doesn't matter if it's going up or going down. Delta. We've already touched on the word delta, about the likelihood of something happening. Let's see as well how that's used to manage the trading position of an option. Now, it says here delta is the slope of the value line. Well, what does that mean in English? All we're trying to say is if the underlying asset price moves up or moves down, I know the option price will move up or down, but how much by? That's what delta shows us, the change in the value of the option price according to how much the underlying asset has moved up or down in price. We need to know that for several things. If I've put an option position on as a trader, how am I going to cover my risk? Well, I could just do the opposite position in the market. So you see buy a matching position, opposite direction, offsetting profit and loss. Or I could buy or sell the underlying. So if the option moves up in value by $10, I need to make sure I've bought the underlying as well, so that it also moves up in value by the same amount. But what delta will show me is how much of the underlying I should buy or sell to have a corresponding amount. Or what if I can't hedge one asset with exactly the same asset? What I need to do is find something with similar price sensitivity that'll show me how much of that to hedge. I'll give you a good example. I was in capital markets and interest rates for many, many years, and you would find that somebody would hedge a $10 million bond position with a $9.8 million interest rate swap. Now, although the nominal size of the trades is different, the price sensitivity was the same. So this is what we mean. So delta and options would be equivalent to present value of a basis point for an interest rate sky. Let me give you a tangible example. Now imagine you've bought a call option on oil. Now let's go back to the magical days of $60 a barrel. It's a nice round number. The option is a 20 delta option. So what that means is the price of the underlying moves up, your option value will move up in value by 20% of that change. So let's say oil is at $60 a barrel, and I'm going to charge you $5 a barrel to buy that. So the call option is worth $5. If the price of oil moves from $60 to $65 a barrel, your option will move up by 20% of that change. So $5 change, 20% of that is what? $1. So the option would have moved in value from $5 to $6. So let's just see how that would translate into numbers when it comes to hedging. So you should be able to move it forward here. So look at the first step. So the customer has bought a call option on 100 barrels of oil at $60 a barrel. The option premium is $5 per barrel. So physically imagine you've got your barrel of oil, $5 premium. The next day, oil has moved to $65. So what happens there? If the oil price has moved to $65, your option price has moved by $1 per barrel. So the option price has moved from $5 to $6. Now, being an option, this is on 100 barrels. So what it means is that the profit in the option going up in value by $1 is applicable to 100 barrels of oil, which means the option holder has made $100 profit. Well, what I need to do as a trader is to make sure that I can also generate $100 profit in buying or selling the underlying. So to make $100 profit, how many barrels do I need to buy? I need to buy 20 barrels, because 20 barrels, the underlying price will move by $5 a barrel. That's 20 times $5 per barrel, that's $100 profit. So there is my hedge. What I recommend you do is go through that and physically think about the barrels and think about the option cost, the underlying cost, and see how the two relate to each other. That's delta hedging. So in terms of a definition again, what does delta measure? You've got 4 alternatives. Have a quick look and see what you think would be the most appropriate. Would be the change in premium as the underlying price moves up or down. That's your delta. Now, we don't have to hedge each option or each position individually. What you can do is you can look at the macro level on a portfolio basis. So I have an example here where I can net off the net deltas between the different positions. So in the first position, I'm long 1,000 call options, and you can see there the price sensitivity of those call options. So if the market goes up, lucky me. But I'm also long 1,500 puts. So if you're long a put, you're going to make money. How? If a market goes up or if a market goes down? If a market goes down. And finally, I'm short 750 call options. Now, if you're short a call option, what's going to happen? That means that if the market goes up in value, you've got a problem. Because instead of being long the call option, you're short. So if the market goes up, you've got a problem. And I can see the delta, the price sensitivity on each of these three positions. So what I do is I look at the portfolio delta. There's the underlying call options. There's my delta. There's the put options. And it's a negative delta, remember, because it's a put option. And I'm short, so negative number. There's the delta on my calls. So what it means, I'm overall negative number 105.65. What does that mean? That means if the portfolio moves up in value by $1, my portfolio is going to go down in value by $105.65. So I need to, if I'm not happy with that number, find something that will go up in value if the portfolio goes up as well, just to reduce my net sensitivity. So take a look at this. Again, 4 alternatives. The delta of an at-the-money long put option is what? So between 0.5 and -1, minus 0.5, between plus 0.5 and plus 1, or is it plus 0.5? Remember, you're long a put option. And you get a minus 0.5, so it's at the money, so it's what it should be priced at, 50-50, and it's a put option, so it's a negative number. Something else you will come across as well is the concept of dynamic hedging. Sometimes you can't just put a trade on the books and have a fire and forget hedge on the other side. It's not like a swap where you could theoretically have the opposite position. Sometimes you'll have options where you have to manage the hedging every day, rebalancing it, buying a bit here, selling a bit there. But here's the problem. Every time you're buying or selling something to hedge your position, you're crossing a bid offer spread. It's costing you money. And if you're not careful, you're going to spend so much money hedging yourself that you've spent more doing that than you have in earning premium. So you want to be very careful about the cost of hedging and also the risk we said earlier of the market gapping when you want to hedge, but there's simply no market out there. It's moved against you too quickly. Final term that you'll come across is gamma. Now, for many of you, gamma is just a term you hear about with the Incredible Hulk. If you're going to be an options trader or a derivative salesperson, you do need to know gamma, but the reality is 99% of you will never get involved in it. And even when I was in derivative sales, we never got exposed to gamma, but it's a term that traders should be aware of. Gamma, basically, if you get asked this in an ACI exam, is the rate of change of delta. And it's at its highest when an option is at the money and it's about to expire. Let me give you a very good example. Remember on digital options, we said that you have a fixed payoff. So at say 10 o'clock next Thursday, if euro-dollar is above 110 or higher, I'll pay you $5 million. If it's below that, you get nothing. Well, that's at 10 o'clock next Thursday. Imagine the week goes by and it's now 2 minutes to 10 on Thursday. And your nightmare is about to start. Because 1 second you're looking at euro-dollar, it's 109.98, no payoff. Then it's 1.1001, $5 million payoff. Then it's back to 109.99, no payoff. So your delta, 1 minute you're 100 delta, next minute you're 0 delta, power, you're flashing back and forth. What banks try and avoid is having too many options around the same strike, expiring on the same day. So it's like stagger it out, it's good risk management. Otherwise, it could be that that's the day when you had all these options expiring at the same strike when the market jumped up or jumped down. So you want to be aware of what gamma is, but the likelihood is for 99% of you, if not more, you're never going to actually have to manage a gamma position unless you happen to be an options trader. Just be aware of what it is. Another key input is time decay. Now, we know that if you buy an option, there's going to be a certain element of the premium which takes into account time and volatility. So a 6-month option would naturally be more expensive than a 3-month option. More things can happen. If you buy a 6-month option, everything could stay the same: volatility, interest rates, the strike, the underlying, but the value will still drop. That is time value. So I need to measure how much this time value is going to affect the premium of the option. Now, at the beginning, they'll probably be relatively linear in its dropping off, but as it gets closer to expiry, it drops off pretty quickly, almost exponentially going down. So one of the Greek letters we use is theta, which will quantify the effect of time value on the option premium. What I'd like you to do now is take a look at the 4 definitions you've got below and see which one of these would apply to gamma. Now, we've already discussed delta, theta, vega, gamma. Which of these applies to gamma? And you should be coming up with C. So gamma reflects the rate of change of delta, and we said it's particularly strong in things like digital options. Now, a final Greek letter we come across is rho. Rho shows us the effect of interest rates on the value of our option. Now, interest rates are applicable for 2 reasons. We said one is it will help calculate the forward price of an asset, but also when we discount the present value or discount the future value back to a present value of the expected payoff, this is where interest rates will be involved. So what rho does, it shows us the effect of interest rates on the value of the option. So that concludes a very brief look at the Greeks. If you want to look at them in more detail, I've got a booklet called Options 201 on swapskills.com, so do take a look, and that will go into a much deeper level. Let's recap what we've actually covered in this module. We've looked at the basic terminology of options: calls, puts, strike dates. We've looked at the different types of options: European, American, Bermudan. We didn't cover path dependent. We looked at Asian and digital. The reality, we said, is most of you will come across just European options, one phone call, pretty straightforward. We've seen why they're used by commodity speculators, equity derivatives portfolio managers, or maybe in trade finance, where you're looking to protect the cross-border value, which could be impacted by currency movements. One other thing we looked at was the high-level concepts of option pricing, so you can see the key ingredients. So if a client wants to decrease the value, the cost of an option, what steps can they take? Now, it's very, very important if you're going to discuss options or get involved in them to understand how payoff diagrams work. If you're not sure about the concept of payoff diagrams, do a spreadsheet, whatever it takes to make sure there's no misunderstanding. And especially if you go onto the sell side of an institution on a bank and you're selling option-based structures, whether the option is embedded, so it's indirect exposure, or directly done, make sure you completely understand the drivers of the value of the option, because you can lose a lot of money if you sell options. So suitability and appropriateness are key watchwords here for all players in the market. Finally, we looked at the Greeks in a little bit of detail. This is just for fundamental to intermediate, so we haven't gone into too much detail and looked at other pricing models. I hope you found this useful. What I'd like you to do is, if you want to look at things like foreign exchange, I've got a superb online FX course on Teachable. So if you go to swapskills.teachable.com, there are over 20 little videos, multiple choice questions, transcripts, which will take you through from the A to Z of options. If you want to look at the booklets I told you about, go to www.swapskills.com, and if you have any questions, email me at simon@swapskills.com and I'll get back to you when I can. Hope to see you again soon.